Well, markets certainly performing well over the past year despite geopolitical tensions and more. Why is that? What can we expect from here on? We're joined by Marc Wait from Providence Wealth. Marc, welcome back.
Thanks, Andrew. Nice to be here.
It is quite something, isn't it, to behold what we've seen on markets, because there has been so much turmoil. There's been this disruption. We're seeing that again, and not the least geopolitically, but also AI at the same time. Why are we seeing markets continue to rise?
So, I think if you go through the laundry list of things that's happened, it's quite remarkable. If you think about, we started the year, President of Venezuela was abducted by the US and moved to the US. You had sort of claims on Greenland. You've got continued tensions in Iran. Yet markets have done quite well. And in the middle of sort of to the early half of last year, we penned something called Solid Foundations. And I think if you look at the sort of global economy, there's been a lot of good supports over the last sort of 2 years or so for markets. And they really come around sort of supportive fiscal policy, supportive monetary policy, really improving earnings, and critically sort of a broadening of those earnings. And I think that's been an interesting story this year, as you sort of see that broadening of earnings. And that's been coupled in an environment where we've really started to sort of pare back inflation from some of those worrying numbers that we saw back in 2021, 2022.
Now, this comes with that fading the US trade that we have seen, certainly concerns about what we're seeing out of the US, courtesy of many of the policies of Donald Trump. Interested then that you're looking at 2026 as passing the baton. So just elaborate on that.
Yeah, so we sort of did our 2026 outlook and we called it passing the baton, and it's really sort of a commentary on, we need to think about which market are we talking about when we say that markets are expensive. And Bank of America's chief equity strategist in the US put it really nice, sort of succinctly, and she looked at markets and all of their valuation measures. On 18 out of 20 measures, the S&P was expensive. So she said there's no way to sugarcoat it. The S&P 500 is expensive. And I think that's what we're seeing. We're seeing reaction that when assets are priced at quite high levels, it doesn't take much to have a chink in the armour. And you can really see that in earnings season. If you look at the price reaction to some of the large cap stocks, they really need to outperform to get that price pop on the upside. And then on the downside, little things can really upset the apple cart. Against that, when you look at other markets, you've started to see capital flow elsewhere. So if you look at mid caps in the US, small caps in the US, you've seen a declining dollar, you've seen really good improvement in earnings in countries like Japan, in areas like a range of emerging markets. And I think capital has gone towards where the value's been, particularly now that you've seen a change in that earnings trajectory. So no longer is it sort of a story of just US exceptionalism. There's some interesting assets elsewhere that continue to be at sort of reasonable valuations. And we've really sort of started the year where you've seen meaningful capital flows into those markets.
All right, so where would you be looking then for those opportunities?
Yeah, so we've talked about it before on the program. We continue to like the Japanese market. It's performed very strongly. I think there's some really important dynamics that are going on there. And if you look at the sort of the backdrop with the sort of stunning victory that you've seen from the Prime Minister, Takaichi, that's very supportive around sort of fiscal policies, a populist sort of mandate to cut taxes. And you've also started to see earnings start to get better. And I think the third thing that's really interesting over there is you've seen continued reform. So if you look at the Japanese stock market, as opposed to other stock markets, they have a lot of companies listed there. So there's a really big, nice long runway for consolidation. And our activist manager continues to see really interesting opportunities to consolidate companies, to have companies move off the market through the private equity holders, private equity firms that are pretty active here. Last year was the most active year for about 10 years in terms of private equity activity. So that's one area. The second area that we like is in terms of emerging markets. Now, if you think about emerging markets and we go back to the start of our careers, it was really sort of, there's been three phases. There was the China boom phase in sort of the late 90s and the 2000s, and valuations moved up towards those of the developed markets. But post the global financial crisis, there was lots of issues around sort of what you're seeing in the internal workings and central banks and currency volatility, and they've really sort of put their houses in order. And you've had really big underperformance. So you can now buy emerging market equities at a 40% discount to the S&P 500. Or a 35% discount to the ACWI world. And when you look at those types of valuation discounts, when you have the sort of robust earnings that are as good, if not better than the US, I think capital started to flow there. And the thing that's really sort of fired up that trade has been a lot of the geopolitics. So if you think about where people want to put their capital, they want to move away from expensive markets. They want to move away from markets where there's lots of geopolitical activity and have a little bit more diversification in portfolios. So it's actually a really good environment to diversify into those areas.
And Mark, of course, given the geopolitical developments we've seen, that is in part reason why we've seen gold and silver move so dramatically. How are you placed? So what's your exposure there?
Yeah, so we've had gold in our portfolios since 2019, and we've had a meaningful position in there. So we've really sort of ridden that wave quite well. I think what you've seen recently is you've seen those types of parabolic moves in markets, and they really portend quite a lot of leverage in markets. And you've seen it becoming a little bit of a crowded trade of late. So we've actually taken a fair bit off the table, and we've sort of halved our position. So we had a 5% position initially, it moved up to 8%, we kind of took it back to 5%, and we're now taking it to 2.5%. It still plays a role in terms of geopolitical diversifier, but I think when you see markets move up as quickly as they have, it's probably a little bit of a time for a pause in that trade. And I think when you look to that sort of February 4th day, I was listening to a podcast recently, and Goldman Sachs was saying across their prime brokerage platform, it was the worst day since the tariff day last year in terms of downside for a lot of the hedge funds that we're managing. So I think it's really sort of been a leverage washout. There's still a little bit of leverage in that trade, so it might be a trade where we sort of see not as stunning returns as we've seen historically, and you definitely want to right-size that position within portfolios.